So we're back and talking with Don Moore and BJ Lechner, Decision Associates M&A, and I know that a lot of the clients that you and I have talked about is, they tend to be, the companies you deal with are usually in that range of maybe as small as 10 million and maybe as large as 100 million or more. But there are a lot of young entrepreneurs in the region, a lot of young entrepreneurs that probably reach out to you that, they're buying their first business, they run it for a few years and they think, okay, I took it and it was maybe even just $500,000 a year in sales revenue, and I've gotten it up to $3 million or so. But I've heard you say that those really aren't companies that are ready to sell yet. They're not big enough yet. Can you talk about that a little bit?
I think the first thing that comes to mind is that if you have a small business, say $3 million, you're really excluding any of the large buyers. We talked about Fortune 100 or people of that ilk. 3 million or 5 million is oftentimes way below their threshold. In other words, they're not going to go through all the trouble, all the expense of acquiring a business that small, because it's just insignificant in the whole scheme of things, and it's not going to get the attention. The exception to that would be if it was something unusual, like they had a proprietary product that the company wanted to buy. Mm-hmm. But generally speaking, they're just too small for a large buyer to deal with.
Mm-hmm. Yeah, sure.
And then on the small buyer side, the buyer there is someone like the seller, or what the seller was a few years earlier, and very often they have limited capital. They're raising a family and they're working and they want to be self-employed, and so the buyers tend not to have. Let's take a company that's about $2 million, and let's just walk through the math. The bank is not going to want to lend more than 50 or 60% of that, because there's a considerable amount of risk there. So that other 40 or 50% has to be made up with the buyer having their own capital. And in a $2 million business, you're talking about having to have at least $500,000 to bring into the business. And so maybe the parents are providing that. In many cases, that's what's happening. The parents or a friendly family investor is investing that, so that it helps minimize the debt. But now you own a business that is essentially 100% financed. The debt's substantial, but you've got to grow the business and you've got to have good employees. So the whole financial math around buying a smaller company is difficult. They do sell. Some of them just wrap up and liquidate.
Oh, okay.
But when they sell, it usually looks something like the buyer comes on board, works for a while, proves they can run the business, and looks good in the eyes of the bank, because now they've got a year or two of working it, and the bank is comfortable that they're capable, and the seller usually ends up being the bank. Not the bank being the bank. The seller agrees to, you can pay me over 5 years or 7 years or 8 years. And if the buyer is a good business person, it all works out. But there's risk for everybody, right? Because now the seller is holding the paper, so to speak, to use that term, and they're like a bank with one loan. It doesn't feel very good. Sure. So these can be hard, and we have helped people through those, right. As much because we care about the community. I mean, we've done some of them at no charge, just right. to help perpetuate the business and help the buyer and seller.
Kind of a related question. I've heard you use the term lifestyle business, and so basically somebody, and maybe the company's even been around for quite a few years, where it's provided a nice income to the business owner and maybe to key family members, etc. Are lifestyle businesses able to be sold, or do they just go away?
They're difficult to sell, because going back to the EBITDA, if it's a lifestyle business, there's probably a lot of expenses there that the new buyer wouldn't necessarily have to take on, but it's hard to document that.
Mm-hmm.
And a lot of people don't want to document that. The other thing with a small business is that the transaction, the cost of the transaction isn't a whole lot less than a big transaction. You still have a lawyer involved, you have CPAs
Right.
involved, and things of that nature, so that becomes a bigger piece of the pie that, goes to
Right.
the expense category.
Well, one of the things, I think I remember this example from a few years back, but one of the challenges I think for small businesses and those that may be more lifestyle oriented is that some of them, because of their nature, may be operating more on a cash basis. And so, they're, as they do their transactions, et cetera, maybe they're requiring, they want people to pay in cash, et cetera, or they're, it's not all the income is able to be seen. Is there a challenge there and advice you'd give to a small business owner who's like, at some point I'd like to sell this, but I'm kind of operating on a cash basis?
Yeah, if you're operating on a cash basis, you're very unlikely to want to disclose that.
Right.
For obvious reasons. So it's very difficult to unwind that. And our best advice is run your business, just run it squeaky clean, because you're going to have to disclose it to somebody someday.
Yeah, we've said to people, we don't want to know, but it appears to us that the business is making more money than what you're showing on the books. So our advice is, if that's the case, because we don't want the IRS to think we have some knowledge, because we don't want to know, is run it squeaky clean for a couple of years and show everything
all
and
of
show
the
the
actual,
profit.
right, show the sales that are actually there, et cetera.
But the very term lifestyle infers one other fact, and that is that the business doesn't really make money, it's a job replacement. So you're paying yourself $150,000 a year or $200,000 a year, and that's what you'd make if you had a job, but you didn't want to have a job, so you made your own job. But the business isn't making money in addition to that. So for a buyer, that whole $150,000 or $200,000 is going to go into debt service. So now they bought a company and they're not making any money. None of it's coming home because it's all going to debt. Why would they buy it?
Sure.
So those, to close the loop on that, those smaller businesses, $1 million, $2 million, are a difficult financial proposition to make happen. And when they happen, it usually is with substantial, if it's a well-run one and there's profitability above the owner's salary, it usually is mostly buyer financed.
Another
Or
issue.
seller financed, excuse me.
Seller finance, yes. Another issue is that a lot of smaller businesses are maybe professional. So they could be a veterinarian, it could be
sure.
a plumber, it could be electrician and things like that. So if somebody comes to us with one of those businesses, we have to have somebody else that's got the certification already.
Right.
Or if it's not a certification, it's somebody that has deep knowledge of that. It'd be like, selling a floral shop, maybe. If you don't know a lot about that, you're not likely to want to acquire it.
Yeah.
And the only way you're going to learn it is to be in that business with the owner for a number of years. So it's a hurdle. It's a knowledge hurdle, and it limits the potential buyer pool.
Great. Thanks, guys. Appreciate it.